Something is deeply wrong in the heart of the American economy, but most people haven't noticed it yet. On the surface, everything might seem steady. Stock markets still flutter upward, unemployment remains relatively low, and corporate America continues to spend and borrow like nothing's wrong. But behind the curtain, a financial time bomb is ticking. Recently, Jeffrey Gundlach, a man who rarely panics, issued a serious warning. He's known as the Bond King for a reason. His voice carries enormous weight in the financial world. At the Bloomberg Global Credit Forum, he revealed that his firm, DoubleLine Capital, has reduced its exposure to junk bonds to an all-time low. That's not just a cautious move, it's a retreat from a market he clearly sees as unstable. But why would someone like Gundlach turn away from high-yield bonds, which are usually associated with big profits? The answer is simple and terrifying. The risk is no longer worth the reward. The market is packed with bad debt, and it's about to blow. At least $50 billion worth of corporate bonds are teetering on the edge, and when they go bad, they won't fall quietly. This is more than just market turbulence. It's the beginning of a chain reaction that could shake corporate America to its foundation. Are we heading toward another financial disaster, one that's been hiding in plain sight? Hit that subscribe button and let's get into the full analysis. Let's first understand the danger. A junk bond sounds like financial trash, and in many ways, it is. These are bonds issued by companies with low credit ratings. In simpler terms, they're promises made by firms already in shaky financial shape. They offer higher returns to tempt investors, but the risk is enormous. In better times, investors were willing to take that gamble. Junk bonds paid more than regular, safer government bonds. But now, something has shifted. The difference between the return on a junk bond and a U.S. Treasury bond, called the credit spread, has shrunk to around 3.2%. That's very low by historical standards. In fact, it's scarily similar to what we saw in 2007, just before the Great Financial Crisis. Back then, markets ignored the obvious warning signs, and people believed housing prices could only go up. Today, they're making the same mistake with corporate debt. Even though many companies are drowning in debt, investors are treating them as if they're safe. They're desperate for returns, and it's making them blind. But this isn't smart investing. It's dangerous complacency. If you think this sounds like déjà vu, you're not alone. And you should be concerned. It's not just Gundlach sounding the alarm. Jamie Dimon, CEO of JPMorgan Chase, recently said that if he were running a bond fund, he'd avoid today's credit market altogether. That's not a casual remark. This is the man leading America's largest bank. At the core of Dimon's concern lies the U.S. bond market, once considered the world's safest and most dependable financial asset. But that foundation is cracking. Dimon points to a toxic mix: a $36 trillion national debt, ballooning deficits, reckless stimulus spending, and interest payments now exceeding $1 trillion annually. He slammed Washington's disastrous fiscal mismanagement, warning that debt is growing faster than the economy itself. Post-2008 regulations have also made it harder for banks to step in when markets tremble. In short, the system is bloated, blind in key areas, and increasingly unstable. Need proof? In 2022, the UK nearly lost control of its bond market after a surprise budget sent shockwaves through public finances. The Bank of England had to launch emergency interventions to stop a cascade of pension fund failures. Now imagine that, but on a scale 10,000 times larger. That's the U.S. Treasury Market. Large institutional investors, pension funds, sovereign wealth funds, and insurers have begun pulling back. Recent Treasury auctions show soft coverage, meaning fewer eager buyers. Some bonds now require higher yields just to attract attention. Even JPMorgan is recalibrating its risk models, never a good sign. Dimon isn't crying wolf, he's doing math, and the numbers don't lie. Josh Easterly of Sixth Street Partners sees the same red flags. These aren't fringe voices, they're financial heavyweights. On Bloomberg, Easterly warned that private credit is dangerously mispriced. Money is flooding in, but the quality of loans? Not improving. The gap between risk and return is shrinking when it should be widening. That's a flashing red light. He noted that many investors are ignoring two core threats: interest rate changes and the shaky fundamentals of borrowers. Floating rate loans may seem attractive now, but if central banks start cutting rates, those returns will vanish. And in a slowing economy, bad loans become landmines. Traditional sponsor-backed lending? Easterly says there's no value there anymore. 6th Street is now focusing on custom, complex deals where they can structure risk from the ground up. In Q1 alone, 84% of their direct lending came from outside the traditional private equity space. This isn't repositioning. It's retreat and rebuild. And with over $100 billion under management, their shift signals deep concern. The question is, will anyone listen this time? Strangely, while the pros are fleeing risk, retail investors are stampeding into it. Some junk bond offerings are oversubscribed by 300 to 400%. Goldman Sachs predicts that private companies could issue $1.5 trillion in risky bonds next year. Why the disconnect? Desperation. Many still believe the Fed will step in like it did in 2020. But that faith is misplaced. The Fed is now trapped. Its credibility tied to controlling inflation, not saving reckless borrowers. Hoping for a bailout today is a different gamble entirely. So while the experts quietly exit, the crowd races toward the cliff, hoping someone will stop the crash before the impact. That isn't courage. That's financial suicide. We don't need to wait for some future disaster. The signs are already here. For the first time in over a year, more American companies are being downgraded than upgraded by credit rating agencies, and generally the entire US credit rating has been downgraded by 3 different agencies. That's a big red flag. A downgrade means investors believe the company is less likely to pay its debts. These aren't tiny businesses. They're major corporations you've likely heard of. When a top-rated company gets downgraded, it doesn't just make headlines. It shakes investor confidence across the board. If the strong are weakening, what does that say about the already vulnerable? Here's the grim truth. Many of these downgraded companies have large piles of junk debt. If they can't refinance, meaning if they can't borrow more money to pay off what they owe, they'll default. And those defaults will spread. This won't be a contained fire. Defaults on junk bonds affect pension funds, insurance companies, and even regular retirement portfolios. As these bonds go bad, the ripple effects will reach banks, job markets, and households across America. And we haven't even factored in the unpredictable wildcard of geopolitics. Right now, tensions in the Middle East are making things even worse. Israel's recent strikes on Iran have raised fears that the Strait of Hormuz could be blocked. That narrow stretch of water carries 20% of the world's oil supply. Any disruption there could send oil prices skyrocketing overnight. We've already seen what happens when oil prices shoot up. In early 2024, after a brief conflict in the region, oil surged past $110 per barrel. That triggered inflation panic in the US, and the Federal Reserve had to delay interest rate cuts. That's a problem. Higher oil prices mean higher transportation and production costs for companies. That squeezes profits. If inflation rises again, the Fed can't lower interest rates to help struggling firms. That puts debt-loaded companies in a terrible position. They need cheaper credit to survive, but they're more likely to get higher borrowing costs instead. Imagine being deep in debt and your loan interest just doubled. That's what many corporations may face in the coming months. Add in global chaos and surging oil prices, and the entire debt structure of corporate America starts to look like a house of cards in a windstorm. Here's something that makes this situation even scarier. A huge portion of corporate debt isn't even visible to the public. It's sitting in what's called the private credit market. This $2.5 trillion shadow system involves loans made by private lenders, not banks, and often with little to no oversight. Private credit exploded in popularity after 2008, when banks pulled back on risky lending. It was supposed to be a safer alternative, but it's become a blind spot. Many of these loans go to the same risky companies that issue junk bonds, but without the same level of regulation or transparency. If those companies start to default, no one will see the cracks forming until it's too late. We might not even know who's holding the risk, or how deep the losses run. This is how a quiet crisis becomes a sudden disaster. Think back to 2008. At first, only a few mortgage lenders failed. Then the banks collapsed. Then the global economy fell into chaos. We're now watching a similar situation unfold. Meanwhile, inflation, which was once thought to be tamed, is now making a comeback. It's not loud, but it's persistent. And for bond investors, it's more than a nuisance. It's a threat to survival. Inflation quietly eats away bondholders' returns. Each month, they get paid less in real terms. It's like being paid in sand while the tide rises. Every uptick in inflation means the real return on these debt instruments shrinks. And for junk bonds, where risk is already sky high, that erosion becomes dangerous. Already, the damage is measurable. Nearly $50 billion in U.S. corporate bonds have been downgraded to junk status in 2025 alone. A staggering number, especially when only $8 billion have managed to claw their way back into investment-grade territory. That's a 6-to-1 downgrade to upgrade ratio. The imbalance is not only alarming, it's a flashing red light in a market that still pretends things are under control. And yet, as the Fed prepares for its June 18th meeting, few expect any rescue. Rates are likely to remain high, possibly with hawkish language that suggests more tightening or a prolonged pause in cuts. That may help in the war against inflation, but it's a death sentence for over-leveraged companies. They can't refinance, they can't survive, and the Fed knows it. The message from Washington is clear: help isn't coming. So, if inflation stays elevated and the Fed stands firm, what happens next? The answer lies in the growing pile of distressed debt. And it's not a small one. But this isn't just about economics anymore. It's becoming a survival question for some of America's most recognizable corporations. When large companies fall, they don't just break themselves. They break the world around them. Consider Warner Brothers Discovery. A legacy media brand, one that once symbolized Hollywood's global dominance, is now a fallen angel. That's the term used when an investment-grade company gets downgraded into junk territory. Moody's dropped Warner's rating after its announcement to split operations, an admission that it's struggling to survive intact. This is not a penny stock collapse. It's not a startup failure. This is a cornerstone of American cultural and corporate identity being stripped of its financial dignity. JPMorgan now lists this downgrade as one of the 5 largest in its index's history. And when giants fall, the fallout is widespread, hitting everything from mutual funds to pension systems to ETF exposure. If Warner Brothers can't survive the weight of its debt, who else is teetering? How many more so-called blue-chip firms are secretly on the brink, hidden behind creative accounting and buyback-driven balance sheets? Each fallen angel adds to the systemic risk. And with every downgrade, the cracks widen. This isn't some distant threat. The collapse has already begun. Just quietly, behind closed doors. The real question now is, how long until the dam breaks? Will Washington act before it's too late, or is the reckoning already underway? For more deep analysis of the global economy, subscribe to the channel and stay one step ahead of the storm.